Hi everyone, this is Kristen Newton, Marketing Director at PMR, and you're listening to our podcast, The Blue Table Talk. On today's episode, I will be joined by our sales team, Cliff Hope and Ryan Carafiello, where we will be covering the topic of hedging. The purpose of this discussion is to properly define what a hedge means in catalytic converter processing, as well as illuminate the different facets that should be considered when hedging in a volatile market. If you're currently missing pertinent information when it comes to hedging your catalytic converters, this is the podcast for you. With that said, let us begin. Hi everyone, my name's Kristen. Welcome to our Blue Table Talk podcast. Today I'm joined by my colleagues Ryan Carafiello and Cliff Hope, and we're going to be talking about hedging. So just to begin, what is hedging? I decided to pull out a definition from Investopedia, and they define hedging as a hedge is an investment that is made with the intention of reducing the risk of adverse price movements in an asset. So to put this definition into context with catalytic converter processing, the asset would be described as the precious metals contained within the catalytic converter, which are platinum, palladium, and rhodium. Cliff, Ryan, you agree with this definition of hedging and what that means?
Yeah, I think it's a great definition, but I think we need to simplify it for our listenership and just to really solidify what it means to converters in real time and how you buy them and how you protect yourself against market swings.
That's fair.
Very good simplification. In terms of a comparable analogy for another commodity, I know we've discussed this in great lengths amongst each other. But Ryan, I know you recently had a discussion with one of your suppliers recently, and would you like to weigh in on that, having a comparable in terms of hedging with another commodity?
Yeah, I think we've always kind of known there's really not a comparable, but I think a lot of our bigger corporate clients that are trading non-ferrous on a daily basis, they really don't understand that even though converters are technically a non-ferrous item, they're really not. So all the other metals, copper, aluminum, brass, they really get traded with a formula sheet off, let's say, off a COMEX or something like that. So at the end of the day, when they want to sell, they're inputting, a pound or a weight. They have a formula based off current market, what the spread is, what both companies, buyers and sellers are going to take from that. And it's very easy for them to hedge or lock in prices because, they're dealing with one metal. And I think the complexity in our business is, we have three metals and they're going up and down every single day. They're
every
moving.
Minute.
It's really, there's no comparable way of putting those two together. But
even give it one step further. The metals that the large non-ferrous companies are dealing with are actually those elemental metals. Copper is already copper. Aluminum is already aluminum. Whereas converters are more like minerals in the ground.
Yeah.
Because they still have to be processed, and it takes
go through many stages,
115 to 120 days to get them to those pure states.
Yeah.
When once again, copper is copper.
Yeah.
Whether it's got plastic sheathing or not, it's still the elemental.
Yeah. And then you times it by three metals, right? So it's not just one.
And I think that what Cliff said brings us to the point of hedging timelines and contracts, right? With copper, it's different than hedging your catalytic converters because you do have to wait for those timelines. So do you want to elaborate on what those timelines look like and how long those timelines may be when you're hedging catalytic converters?
Well, I think the rules in trading metals, period, is that they have to exist. So back to my point, copper already exists. Whether it's got wire sheathing on it or not, it's still elementally copper, and there can be a weight assigned to it. When we talk about catalytic converters, there are precious metals that need to be transformed back into their pure elements. And as I said, it takes about 120 days to do so. From our end of things, we're processing converters, bringing them to the stage of understanding what's contained within a given batch, but there's still a lot of processing that goes forward with that. So in order to hedge it, we actually need a company to have those metals in stock or actually in hand, kind of like Fort Knox, I think is the best way to, we used to have the golden rule, money and gold actually there was an equation between the two. Well, in order to sell one precious metal ounce, that metal ounce needs to exist in reality.
Yeah.
And so we need to have somebody that has it physically to actually hedge a market price, and we need to then deliver the metal down the road, or we contract the delivery. So they're essentially leasing us their metal ounce until we replace it.
Exactly. And I think a lot of our suppliers don't understand that when they hedge, we're also taking a hedge position with the commodities market, right? And depending on what type of processor or tool refiner you're working with, it could be anywhere between 115 to 150 days to get those precious metals back into physical form and on the market, right?
And there's a cost to that. The people that actually have the physical metals, while they are going to make money on leasing them out to somebody who is now hedging in a future market, that's the cost. They're actually, they don't just want to have the metal there just sitting there waiting to do nothing.
Yeah, exactly.
Yeah.
So now that we've talked about what is hedging and went through the definitions and the context in relation to catalytic converter recycling and processing, let's jump into how hedging works with a processor, right? So Ryan or Cliff, do you want to just describe how a hedge is made or calculated with any given shipment coming to us?
I'll start with it. So basically, it really depends if there's history or there's not. When there's no history, obviously it's harder to make a hedge up front, but at the end of the day, you're really hedging a specific amount of precious metal ounces of platinum, palladium, rhodium.
What do you mean by history, Ryan? Just because I think that's an important part of the conversation.
Yeah. So again, like let's just say if it's your first load into refining or your first load to say a new toll refiner or processor, you're not going to have the history of the readings of platinum, palladium, rhodium, the ppms. You're not going to have a history of the weight per converter, which kind of all takes a part in generating those returnable ounces. So I think if you really don't have the history in terms of lots of loads, you really want to work with a company that will be able to use national average. Let's say call it 2 pounds a converter and use X amount for platinum, palladium, rhodium. And you probably want to make a conservative 60 to 70% hedge up front until that final assay is done, until you really know what's there. So I think that's what I would say is how it would work for no history. And then when it comes to history, it's always going to fluctuate up or down. But I think hedging 80% before you ship a load, if that's what you choose to do, should kind of, at the end of the day, give you coverage on most of it. Could turn out to be a 90% or 100%. Could be turn out to be 70% of the final. But I think that's kind of where I'm going with it.
I think it's important for anybody to listening to this and learning what that really means. I have numerous conversations with clients about hedging and why they should or shouldn't.
Yeah.
And I would say perhaps never shouldn't, because markets are so volatile these days, or in any given time frame. The should is obvious. If you're buying converters in a given market, covering that those metals up to 80% is really going to lock in your margin in your buying.
Yeah.
Nobody wants to give up profit or margin and for hard work. I mean, we really do hard work in all of this. And not hedging certainly leaves people exposed to, once again,
adverse price movements.
Absolutely.
Yeah, for sure. And I think what we need to consider too, when we're talking about how a hedge is made or calculated, you as somebody who's looking for a buyer processor, is this a question that they can answer? Because if it isn't, that's something to consider when you're choosing somebody to move forward with.
If you're new into the refining space, it can be very scary, right? So you don't want to overhedge, underhedge. You might not understand whatsoever any of that because you just know I have 500 catalytic converters, right? So I think you got to start with the basics. Like we should even quickly touch on that in an average load, you're going to see majority of palladium ounces, and then you're going to see more platinum, and then you're going to see rhodium, right? So that's on an average load. Obviously, later model, you're going to see platinum and rhodium moving a little up and down, but
And I think that brings us into something specific that we offer here at PMR is the hedge all option. Well, Cliff, do you want to elaborate on what this hedge all is and who's qualified to obtain it?
Absolutely. So first off, what we're talking about with a hedge all is a notion that we're going to cover the over-unders as far as ounces and output of material. We're not going to do that until we have history from the client. So that client should be consistent with us, and we should have enough history to average. And then the next part of it is we're not going to offer this option for more than 350 units in any given shipment. When you're drawing a line in the sand, because there is a risk that we're going to take in covering the over-under on this. And we're confident enough in our clients and the history that we share with them that they will ship us like material. And it's really a service that we're offering. So they don't have to worry about, what could happen in a potential overhedge situation in a market that's going up. And we can talk a little bit about what that would mean later as far as a financial consequence.
Yeah, that's exactly what I was just about to lead into was, if we were to provide an example for an overhedge or an underhedge, what would that mean? What would a brief example of those two situations entail?
Absolutely. So in the simplest terms, I'm going to use the example of one metal because we have three metals here, but we're just going to take one just for the sake of ease of conversation. And we're going to talk about what happens if I hedge 10 ounces of platinum at a market of $1,000. So essentially we have $10,000 worth of platinum ounces to deliver to the buyer, and we've locked in that price. So what happens if my load only comes out with 9 ounces of platinum? Well, we have to buy back that last ounce. And we have to buy it back at the new market because the market's definitely going to change. And once again, for ease of conversation, let's talk about what would happen in the event that the market went down. So we had $10,000 worth of platinum that we're supposed to deliver. We're only going to deliver $9,000 or 9 ounces, and we have to buy back 1 ounce of platinum at $900 an ounce. Oddly enough, that actually means that it's going to make $100 for the short sale of the metal.
So you're in a positive in the
essentially. I mean, while you may have been expecting to get $10,000, you're not because you're only delivering 9 ounces, but you're going to get $100 for the buyback of the ounce at a lower market. The reverse on the other side, let's say that the market went up and we had an $1,100 ounce of platinum now that you had to buy back. You're not actually buying back all $1,100. You're actually just going to compensate the person who leased the metal the $100 of the market going up in that case. So now your load from you're going to get $10,000. Now you're only going to get $7,900.
Got it. All right, so those numbers and figures are pretty easy to follow along with. To build upon Ryan's previous point about having a partner that's able to give you detailed information on your past lots, a better understanding of expected ounces. Sorry, I'm just going to repeat that. So having a partner that can provide detailed information on past lots to get a better understanding of the expected ounces after processing your material. What would you say everybody needed in terms of hedging support? What would a supplier need when searching for somebody to help them when understanding hedging as a whole, Ryan?
Well, I think you have to understand like the matrix and really the methods of how it gets calculated. It's obviously it's the weight of material that you process times the ppms, parts per million, and then basically you get returnable ounces times the market. So that's kind of how you're getting the value at the end of the day. But they need to understand those figures, obviously weights and ppms. You can also work with some companies that have tools right in their database or online system that you're inputting a unit count, which is kind of their language, and then it's going to spit out based off their history the amount of ounces. And then from there, once they get that information, if they're used to trading other non-ferrous metals, it really becomes the same. So they're like, okay, I want to hedge 50%, 60, 80%, whatever the number is. So I think you really need to understand what is getting you to making those hedge, what are the important factors that determine it, and then from there, based off history, just kind of average it out and use a fairly aggressive but not too aggressive hedge.
But how about this? I think it's really important to frame that for people that are listening today, in the sense that if you're working with a toll refiner and they're a partner,
Yeah.
and as much as they're a partner, there should be a two-way conversation on how much you can hedge,
Yeah.
how much you can protect yourself, and what should be considered, I'm going to say, relevant for you in any given circumstance.
Yeah.
Because everybody runs a different business, and
Yeah.
how they see risk, how they want to cover margins, what's happening within a market structure. So having a professional on the other end of the line being able not to advise, just to give guidance in what's possible.
Yeah.
So basically, a partner that's really giving you an understanding of your investment and the knowledge to feel comfortable in making a hedge when you do, because you feel like you have all the information you need to make that decision.
Yeah, we can only give all the options, right, and explain how it works. And again, you might hedge 90%, and you might have a lower weight than your average. You might have a lower PPM, and you might have an overhedge. But at the end of the day, us companies, we can only, once there is history, we only can give what the numbers show, right? And it's not always going to work, but for the most part, it does.
And quite frankly, we don't really want to have anybody in an underhedge or
Yeah.
overhedge situation. And it's much better for us to be as accurate as possible with our customer base, because I think it makes them more profitable overall.
Just another thing to kind of just to add in there, talking about the hedge all, it's kind of a privilege that we give some suppliers, but it can be easily revoked when your account's off. So, I think the number one thing, we talked about this in other, podcasts, knowing your count straight from the yard is the most important. Because if you don't know your account and you're off, it's going to throw off everything down the line, right? So I think you really got to understand the converters. You can't just say, hey, I want to hedge 3 boxes. I think that's the email we get all the time, and I just laugh every single time. It's funny
So
to me.
I think that to build upon your point, what you're saying is, you have to pick a processor that gives you the most information, but at the same time, you have to be as transparent with your processor too, and make sure that you're giving them accurate information so they can give you accurate information. So to go upon questions that we get asked often, I'm going to ask you guys one that we get pretty frequently in terms of market analysis. So how often should you be tracking market pricing when dealing with converters and hedging?
I'm going to say every time you're buying. If you're actually buying converters, and we have a live market, the market is always moving. So you should be consulting that market or locking in a metal price to make those purchases throughout the course of let's say the space of a week.
Which not many people consider as much as they should, right? A lot of them will purchase the material and then consult prices afterwards, which doesn't make much sense, right? When to further reduce risk, you should be buying and selling relatively in the same market, right?
I'm going to say yes, but it really depends, because if we had this conversation 2 years ago, we were in an upswing market all the time. And so you could buy and you could then sell later and make money. And actually, many people did and did well, and they could do no wrong. We're not in a necessarily downswing market right now. We are in a volatile market, which is even more challenging. We have $200 price swings on a metal in a day. And so if you bought converters in the morning and you didn't lock them in, you could have lost your margin by 3 p.m. that afternoon.
Exactly. Depending on what type of margin you're working off of, and then some, so.
No, I agree with Cliff. I think that it should be looked at on a daily basis, but not really for all, right? Because if you're really only selling once every 6 months, if you have a margin built in, and I'm assuming if you're only selling that frequent or not frequent, you're going to have a very large margin onto, deal with fluctuations. But I think it depends. You got to really look at companies that deliver material weekly, bi-weekly, monthly. They're definitely looking at the market on a daily basis or per buy. I think some other companies, maybe even some auto recyclers that don't have as much money into it as a purchased unit from a scrapyard, they can play it a little bit. But again, it should be something just like all the other metals that you're following all the time.
And you know what? If you're an auto recycler and you're listening to this, and I think it's important, if you're buying the car in a certain market, regardless of what other metal prices are doing, having the knowledge of what you have into the car with the cat, really could make a big difference to your bottom line. And again, following a volatile market can be challenging, which is why you need a professional that's going to give you those kind of cues.
For sure. But the truth is, if you're frequently purchasing and selling, if you want to have a better understanding of your profits and control of your investment, you should be tracking the prices, right? You should be tracking them frequently. All right, so let's go into the concluding topics of this hedging discussion. I'd like to talk about the multiple prices that are displayed on multiple websites like Fast Markets, Kitco, Metals Daily. What are these prices showing us? Because a lot of people don't understand that these are spot prices. So I'd like Ryan or Cliff, would you please elaborate on what is a spot price and why we're seeing these prices on these websites?
So we have lots of websites out there, and they're producing a lot of data. And oftentimes at different pricing, and it does become confusing to the people who are out there buying and selling these metals from a converter's perspective. Most of these websites are not displaying the cost of leasing the metal, so they're showing live buy and future ask prices that for deliverables, without any type of notion of leasing. They're really talking about physical metals.
So just to simplify that, what Cliff is trying to say is they're showing you the prices that they are offering people with the physical commodity available for resale in the commodities market.
Yeah, after 120 to 150
exactly,
days.
which is what we were discussing before.
Yeah. So we're really dealing with locking and ensuring margin on metals that technically don't exist. So in that sense, there's risk on all ends. If we're actually as a toll refiner hedging for somebody, and we're hedging in advance of actually getting that material, we are still on the line to deliver those ounces. So it's there is something to it as well, for sure.
And I think what people need to understand as well is that lease rates change as well. If the market is oversupplied in comparison to demand, lease rates will be low for those metals. Whereas if the market was undersupplied in comparison to demand, those lease rates will be high. So,
on your point, a couple of years ago, it was palladium. I think it was 800,000 or 900,000 ounces, ounce shortage in the market.
Exactly.
So obviously, the
lease rate
higher.
was extremely higher at that stage.
Well, and this is where the people with the physical commodity wanted to make sure that they were making money on that in a short market.
Yeah.
So they were sort of ensuring their profits, because they could have sold at the higher rates. So in this case, they're actually making money over the long term by leasing that material.
And I think when you're choosing a toll refiner or processor to work with, you need to ask yourself that question, right? Are they showing me a price with an incorporated lease rate, or are they showing me those spot prices and eventually will deduct a lease rate on my final invoice or on my final result?
And every time I speak with someone about that topic and say, hey, if you wanted to wait 115, 120 days, we could probably get you a slightly better price than what it was, but then you're also waiting all that time that the market has definitely changed, and it doesn't make sense to wait that long.
But at the same time, it also doesn't mean that if you're waiting those 150 days, it doesn't necessarily mean spot price will be higher at that time as well. So they're also taking a risk if they do wait, because it could end up being lower than what the previous price was, let's say 50 days ago with a lease rate.
And the other thing too is, just because a company gives a certain market price that they'll hedge at, that doesn't mean that's where the market's at, right? So at the end of the day, you want to work with a company that's can consistently give you a realistic price that they're actually going to hedge at and deliver, not just one time, not just two times, for years. The way I look at it is, it's the same thing as if there's a a $25 aftermarket and someone's willing to pay $50 for it, doesn't mean it's worth $50, right?
They might do it once, they might do it twice, but if they can do it consistently, it's a very different story. From that perspective, I think and this is just how we do it. We publish what we're willing to pay. There are no reductions. Now, there are companies that just read your terms. That's the most important thing. You really need to understand how your terms are affecting metal pricing and where there might be deductions or lease rates applied.
Or both.
Or both.
Or
That's
both.
right. Or both.
Correct.
Because you could see a hedge and then you could have a reduction and not understand why it was reduced in the way it was.
Yeah.
So, and these are questions that we come across on a regular basis.
Yeah. Especially those that are actually taking the time to dig deeper into what their, toller finding terms are. And, when they're shopping around to understand and get better acquainted. And I think that's an important part of it, is being able to have that conversation with whoever you're selling to really understand what you're being given and offered.
Ironically enough, in this volatile type market, people are having a much bigger look at those terms and the and the pricing of the metal, whereas even a year and a half ago, in an upswing market, nobody really paid attention as much.
All right. Well, I think we had some, good points in terms to, what hedging is, the definition, how it relates to catalytic converter recycling, what to look for in hedging support when you're choosing a toll refiner or processor, as well as, timelines, contract schedules. Is there anything you guys want to conclude with?
I think for me, the only thing to really highlight to a lot of companies is it's not really necessarily just the market, right? People see the market, platinum, palladium, rhodium. I've locked it in, but it's the quantity of precious metal ounces of each three metals is really what we're hedging and what they're essentially selling. So they have to really kind of get away always just looking at the market, but tie the market with the quantity of ounces.
Yeah, there's a multitude of factors associated.
If I had anything to say to people that are buying converters, buy and sell as closely as you can in the same market, or even hedge in advance if you've got a consistent buying platform out there. That truly locks in a margin, and in volatile markets like we see today, you're much less at risk.
All right, perfect. So I want to thank you for joining us today on, this episode of our Blue Table Talk. And I want to thank my colleagues Ryan and Cliff for joining us today.
Thank you, Kristen.
Thanks.